rule, just like the English language, as with any rule, there's always an exception to the rule. Volatility trading is no exception to that rule. Don't do this on stocks where the stock price is less than $10. If you think about this, we are trying to forecast a substantial rise in volatility, hopefully a doubling of volatility. Well, when you go to the restaurant or you go to the store, you don't pull out your wallet and say, well, here's 40 volatilities. They don't take that. They take dollars and cents, and that's it. So the question we have to answer is, how does volatility convert into dollars and cents? Because that's where we make our money. And the problem with cheap stocks is that it doesn't convert into dollars and cents real well. I mean, you might buy an option for 3/4 of a point, and a doubling of that is $75, another 3/4, $75. Well, the problem is your commissions and your bid-ask might eat that up. So that's the problem. You need to be dealing with stocks. Perfect is $20, $50. Heck, I've even done stocks. You and I were talking about Yahoo. We bought a straddle in, I think it was 1999. It was November 99. I can't remember what the expiration date was, but it was the 180, 185 strangle on Yahoo. So that's a long time ago. 185 is fine. $9 is not. This is a trade that we got into recently. I just want you all to just take a look at this chart. This is research in motion. If you don't know research in motion, they have one of the hottest, right now they've got probably the hottest electronic device out there. It's called the BlackBerry, and it lets you send email back and forth. It's really neat little thing. What we're looking for is instances where research in motion shares have gone flat for no fundamental reason. And the top chart shows research in motion shares. Just to give it some perspective, I have a moving average, a couple of moving averages there. I don't use them for anything other than just some perspective. That's all. The thing that's important is what's down below. And these are the volatilities that we look at. And when the volatility criteria is achieved, I've taught Metastock, programmed it, to draw little vertical bars whenever it's gone flat. And you can see, this is an instance right in here. Where is this? Right in there. It went flat temporarily. You can see right in here, it went flat. Right here's a little bit of flat period. Here's another period of low volatility. And you can pretty clearly see right there. Everybody see that? It's like a pancake right there. Well, there's the coiled spring. That's what those little black vertical bars are telling us. It's the coiled spring. And then we simply follow this. So that's step one. Our software is identified a stock, research in motion. The next thing we do, come up with the right strategy, come up with the right entry price, come up with the right exit strategy. In this particular instance, research in motion, we got kind of fortunate. The stock was flat right in here. Remember, it's flat right in here. We put the position on, and then research in motion came out with earnings, and it surprised everyone, and then you had a little bit of a short squeeze. It actually should have updated this chart, but I don't. It actually got up somewhere up in there. And then the question is, it makes its move. As long as I'm in the right strategy, I'm making money. As long as I bought it at the right price, I'm making money. But then, now what do I do? It's moving. How do I take my profits? So we'll get into that. I mean, I'm always thinking about my 4 steps. And I'm saying it over and over again so you get in that same habit as I'm in. This is another strategy. This was about this time last year. Amazon.com. This is one of the great contrarian plays you can possibly imagine. You all know what iShares are? Anybody know what iShares are? They're sector-specific. They're funds, only they trade like a stock. So you can buy, anybody, the triple Q, the QQQ, and the DIA, the diamonds, and the SPY spiders? Well, the iShares are similar to that. The only thing that's different is they go into individual sectors. So like you could have bought the internet sector or the banking sector or the energy sector, and it trades on a stock exchange just like a stock. Well, back in the big bull run, what'd they come out with? The hot thing, the internet iShares, right? Because everybody had to have the internet, right? Well, guess what they did in November 2002? They delisted it because of a lack of interest. Well, guess what you should have done the moment they delisted it? They listed it when it was positive, right? When everybody wanted it. And what happened to the stocks? They went down. And then when they delisted it because it was unpopular. And what happened? They went up. So, a little contrary opinion theory demonstrated right there. Right in here's when they delisted the iShares. You can see, here's an instance, Amazon's flat. Here's another instance. We're concentrating on this period right here. You can see, flat as a pancake. Well, then the question is, what do I do with it? I got a stock that's flat. Now what? Select the right strategy. The first thing you do is you choose your expiration series. Now that was February. It was February. I'm looking 3 to 5 months out. Because remember earlier I said that the moves take about 2 to 3 months in time for the move to fully develop. And you want to give it time to let those profits run. You also want to think about contingency planning. What happens if things go wrong? Well, for most of you, they have a very well-known curve on how time decays in options. And at the money options, they decay parabolically, which basically what that means is that the rate of time decay speeds up as you get closer to expiration. Well, this gives us an opportunity to avoid a catastrophic loss. If the move takes 3 months, I want to buy a 4-month option. If the move takes 2 months, I want to buy a 3-month option so that I can avoid that catastrophic time decay as the option gets closer and closer to expiration. In the case of Amazon, it was February, so I just simply count out March, April, May, 3 months. I look for May. There were no May options listed. I then look for June. There were no June options listed. So I got to go to July. 5 months. Makes it simple. So that's basically, sometimes I'll be down on my base. Well, I don't do that anymore because I have software to do it for me. But it used to be when I was doing this by hand, it's February. Okay, what is it? March, April, May. May, June, July. Okay, July it is. I had to do that, but now I don't have to do that anymore. Okay, again, we want to keep it very simple. We want to use straddles and strangles if the asset, and we want to use straddles or strangles. If the asset price is in the middle of 2 strike prices, choose the strangle. Otherwise, choose the straddle. What that means is, if you have a stock that's at 57.5, you have the 55 strike and you have the 60 strike. Well, 57.50 is right smack in the middle of it. So I need to choose the strangle. And the strangle would be the 55 put and the 60 call. If the stock is right around 54 to 56 in that range, then I'm going to choose the straddle. I'm going to buy the 55 call and the 55 put.